sources of information. Now, as analysts, we of course get these financial statements from companies, and as discussed earlier, the accountants of these companies will be producing these statements and auditors are going to be checking them. But what we want is that, number one, they should be as accurate as required. That is the function of the auditors, that they will check the accuracy. And secondly, not only do we want them to be accurate, we also want them to be in a certain format, in a standard format. Why? Because then we will be able to compare different companies easily, right? Now, how do these financial statements come to be of this standardized format? There are two bodies that help us achieve this. Number one are the standard setting bodies, such as your International Accounting Standards Board, right, which creates the standard International Financial Reporting Standard. Now, these bodies, and there are others, and we will talk about them in more detail, and these are called standard setting bodies. Now, these bodies, they set the standard that, okay, everybody is going to report their financial statements as per these common acceptable standards. The second one are the regulators, which enforce a certain standard onto the companies within their jurisdiction, such as the SEC in the US, and there are other regulators across the world, such as the FRC in the UK. So this is the big picture over here, that with the help of these standard setting bodies and the regulators which enforce those standards and the auditors that work under these regulators to help us check the accuracy of the financial statements, and of course it all starts with the accountants who prepare these financial statements, enables us, the analysts, to be able to get these financial statements which are a source of information which is regulated. It is something we can depend on for doing our analysis and then making recommendations to our clients. So first of all, standard setting bodies, very, very important. They are, of course, private sector. It is the regulators which are public sector, and they help enforce these standards, but they don't develop the standards. Regulators help enforce the standards. Standard setting bodies are the ones which develop the standards. The most popular ones for international, you have International Accounting Standards Board. They have, of course, developed the International Financial Reporting Standards, very, very popular globally. And within the United States, you have the Financial Accounting Standards Board, which has developed the US GAAP, the generally accepted accounting principles. Now, as discussed already, they do not have the authority to enforce the standards. They simply develop or set the standards. Who enforces them? Your regulatory authorities. They are the ones with the legal authority to enforce these financial reporting standards, and they differ from jurisdiction to jurisdiction. So if you talk about the US, it is the SEC. If you talk about the UK, it is the FRC. And of course, you have many examples from around the world. These are the ones who are responsible for your financial reporting. And then, of course, there are regulatory authorities which are also responsible for the regulation of capital markets. Now, in the UK, the FRC, as I just shared earlier, is responsible for the financial reporting. But when we talk about the regulation of the capital markets, it is the Financial Conduct Authority, which then steps in for regulation of your capital markets. And of course, when we talk about banks, there is another regulatory authority in the UK, which is the Prudential Regulation Authority. Earlier in the UK, we used to have the Financial Services Authority, but then it has been broken up into all these separate regulatory authorities. In the US, of course, we have still the SEC, which is the main one. And in addition to all these separate regulatory authorities of these different countries, there is one international organization of security commissions, which is, you can think of it as an umbrella organization of all the regulatory authorities. Now, this is not technically an authority, it is an association of all the authorities. So they themselves don't have any power. It is those respective regulatory authorities which have the actual power. But nevertheless, of course, the IOSCO has a certain amount of influence over these regulatory authorities, and therefore it is a very, very important institution. And what does it do? It develops the objectives and principles for the regulation of capital markets. Now, what are these objectives? Number one objective is to protect investors. Because as analysts, who are we reporting to? Who are we providing a recommendation to? It is investors. So at the end of the day, what we want for the promotion of capital markets is that the investors should be protected. Their interest should be protected. It should be done in a fair manner, efficiently and transparently, so that there is no insider trading, there is no manipulation of information or markets, and we reduce the system-wide risk. We don't want situations like the 2008 financial crisis where the entire financial system was in trouble. So that is the objectives of your IOSCO. Then we'll talk about the principles, that of course your financial results should be accurate and timely, right? And of course they should be full. So any information regarding financial results and the risks should be fully, accurately and timely disclosed, and it should be of standardized quality, which is as per the international or locally required standards. Now, when we talk about standards, there are certain financial statements which are standard, which are required from each company. You have the balance sheet, you have the income statement, and some of you might already know this, but for those of you who don't, you have the cash flow statement, right? These are the three most popular ones, but then there are others as well, such as your statement of changes in equity, and you also have your income statement is presented separately as also the bigger version of this, which is your statement of comprehensive income. Now, what's happening in this big picture is that, let's say you set up a company, right? And that is your balance sheet. It's going to show what is the amount of money you've put in. So let's say you set up a company with $1 million. So that is going to be your equity, right? 1 million. And let's say you take some loan from the bank, which is going to be debt. Let's say another 1 million. And these two together will be your assets. You might have cash or land or whatever. And debt is what we call liabilities, right? There are other liabilities as well. But overall, this is the accounting equation, that assets is equal to liabilities plus equity. And that is your balance sheet, which shows the balance of all these three accounts, which is assets, liabilities, and equity. And within them, there are lots of sub accounts. Now, for example, within assets, you can have cash, property, plant, equipment, and all of these are going to be covered in a lot more detail in subsequent readings. But I want to give you a big picture over here so that I can help you develop your mental map, and then slowly as you go through your FSA, your financial statement analysis section, and all the different learning modules, you're able to fill in color into your mental map. So the first thing we discussed over here is when a company is formed, you put in some equity in that company, right? You might take some loan, that could be your liability, and your liabilities plus equity gives you your assets, and the balance sheet shows that. Then whatever assets you've gotten, you're going to put those assets to use, right? You're going to do some business with it, and that flow of business is going to be shown in your second financial statement, which is your income statement. Now, income statement is going to show your sales, whatever revenue you generate, minus whatever expenses you will have, and then simply it is going to show your profit. Of course, it is more complicated than that, and as discussed, we will discuss it in a lot more detail in subsequent learning modules. But the gist of this is that it shows what revenue you're generating or your sales, what expenses you are having, and what is the profit that you're generating. And that profit then goes back and feeds into your balance sheet, because again, with the assets is equal to liabilities plus equity equation, what will happen is that when the profit is going to be there, your assets will go up. You're probably going to have more cash than you did before, and your equity will also go up. So this way your balance sheet and income statement are related. Whatever cash is coming in and going out is shown in the cash flow statement, and that is also very important. If you're going to decide to pay dividend, let's say you had a nice profit and you want to pay it to your shareholders, so the cash will go down and your equity will go down, and all these details are shown in your statement of changes in equity. Now, that just leaves the last one, which is statement of comprehensive income, and that is your income, but some more complicated parts of the income which are not necessarily showing in your net profit because they are unrealized, and we will of course talk a lot more about this in detail when we get to subsequent learning modules. At this current stage, you simply need to understand the basics. So if you're feeling a little bit lost and confused, it's okay, because this is of course one of the main areas of your CFA level 1, and it will be covered across the next few learning modules in detail. For the time being, just know that these financial statement names which I have told you, balance sheet, income statement, cash flow statement, statement of changes in equity, they are referred to as very complicated looking codes, and you don't need to worry about these codes, right? In the curriculum you will be seeing these codes, but you are not expected to memorize them. They are specific for the US SEC regulatory filings requirement, but as far as the exam is concerned, it is highly unlikely that they will test country specific regulation. Rather, they will be referring to these statements in the names that we have just discussed with you. There are of course some other names of these which are also very easy to understand, and we will discuss those other names as well, but they are not going to be like this where you have these codes such as your 10K or 20F, etc. So let us get into the different primary financial statements. The balance sheet, also called the statement of financial position. Why? Because this shows what are your assets, what are your liabilities, and what are your equity at any given point in time. This is like a snapshot. So at any given point in time, it will tell you what is the financial position of the company. Your income statement or your profit and loss statement, right? So multiple names for this: statement of operations. This is not a snapshot. This is for a period, let's say for 2023, from Jan to December. So for that period, it will show you what is the sales or revenue, what were the expenses, and what has been the profit. Simply put, right? Of course, it is much more detailed than that, and we will discuss in later learning modules what is the full format of the income statement. But at this stage, I just want you to get a high level overview that the balance sheet, also known as the statement of financial position, is a snapshot. It just tells you what are your assets, what are your liabilities, and what is your equity, the value of your company. The cash flow statement just shows what cash came in, what cash went out, and if you paid any dividends, so your owner's equity will be going down. If you generated any profit, your owner's equity will be going up. and that is shown in your statement of changes in owner's equity. So let's discuss them a little bit more. Your balance sheet shows assets, liabilities, and equity.